All right, we are here to talk with a group of experts, Greg and Joe here at Schechter Wealth, on the topic of maximizing your estate. So the estate tax, estate planning, it's growing in popularity. We're certainly getting a lot more questions. Greg, Joe, I know you guys are as well. So we are going to walk through a discussion here on ways to maximize your estate. What does that actually mean? Well, oftentimes you might be a business owner, you might be somebody who has accrued wealth in another way, you might be generation two or three of wealth that you've seen built, and you either read articles or an advisor mentioned to you, hey, have you guys thought about estate taxes? And you went, well, wait, what do you mean? I thought that was just for the ultra wealthy people. Well, estate tax hits far more folks, and we see this increasing continually. So one of the things we like to do here at Altera is bring together experts like Greg and Joe here at Schechter Wealth. So first off, Greg and Joe, thank you guys both for joining the discussion. I'm excited to hear from you guys.
Thanks for having us.
So let's take a minute here. We're going to talk about this topic of maximizing your estate and strategies that somebody could use to address estate taxes. But take a minute here, introduce yourselves, introduce who is Schechter Wealth. What do you guys do?
Well, thank you, Josh. We've had the good fortune of actually now partnering with Altera for the last 4 years. So we always appreciate any opportunity we get to work with you guys and with your clients. So Schechter is a third generation privately held insurance and investment firm. We're based in Birmingham, Michigan, and we were founded in 1939. We're known in the industry really for our life insurance expertise, our advanced planning capabilities. And about 10 years ago, we started to share what we do. We've got 75 employees across all different divisions, and we started to share our capabilities in the advanced insurance area with other advisors like our friends at Altera. Joe?
Great. Thank you, Greg. So I have now been at Schechter for 11 years, focused on the insurance side. I work with advisors across the country. These could be investment advisors, insurance advisors, advanced planning and estate planning attorneys, and I help design and implement conventional and unconventional life insurance strategies for their clients. A lot of high net worth families, a lot of the typical objectives of preserving family wealth, preparing and planning for estate taxes down the road, and really maintaining and building generational wealth. Those are the types of objectives I see the most.
So you guys are two of the three faces here on the screen, and one of the things I've loved working with the folks on your team, with you guys and others, is that everybody comes to the table with unique roles, kind of complementary skill sets, and all seeking to achieve an objective coming together. So Jordan, who if you're watching this, you'll see on the right side of the screen here, he is a foremost expert in the legal space. He's an attorney, and in a conversation with him, you instantly realize how much more there is to know about the legal world and different ways that you can structure your estate than you ever thought possible. So he's just this expert Rolodex of ideas and then selecting the right ones for a particular situation. So your guys' team is awesome. We've really enjoyed benefiting from your expertise. So again, thank you for joining here. So you guys do a lot of things, but two key areas of partnership that we've been able to work together with you guys on are things like advanced design and estate planning, and then premium financing. So we're going to focus in on a case study around this concept of premium financing today. But just talk to me, kind of give me the 30,000-foot flyover of what each of these bubbles represents.
Yeah, and so I forgot to mention this at the beginning, but my role, along with Joe, is to help take this advanced design capability as well as premium financing, this platform, and share this with advisors throughout the industry that want or need our partnership. And so Joe mentioned it, but we work in the areas of conventional estate planning, business planning, charitable planning strategies, and also some unconventional ideas like premium financing. And so you'll find at any given time maybe 20 or 30 different concepts. What's unique about Schechter, though, is because we do have our own retail clients and we also partner with firms like Altera, is that we're not vendors in any way, shape, or form. Anything that we talk about with your clients, we're also talking about and implementing with our own clients. In the area of premium financing, and we'll talk about this in a minute, but we first heard about this Joe, I'd say 10 or 12 years ago. And we like the idea of, for some of our niche, for a small niche of our clients, offering this unique way to purchase life insurance. And we'll talk about the benefits here in a minute. But what's key to us at Schechter is that whatever we design, whatever we help implement, there's got to be an ongoing service element. And so we did not find that there was a suitable service element when we first started talking to these vendors about a decade or 12 years ago. And so we decided we had to build it ourselves. So we built our own premium financing platform. We've got about 18 different banks that we work with. And again, a key part of that, not only on the design side, but really is what we do on the back end in terms of ongoing service.
That's great. And something I've appreciated about you guys as well is all of these things that can sound really complicated, we can boil down to simple choices, education, so that somebody feels empowered to be able to make a choice that has a lot of analysis and rock solid data behind it, but not dragging them through 30 complicated concepts and making them, suffer through all this excruciating detail. Though we certainly have people who, to them, that's not excruciating detail. To them, it's it's the most fun thing they can possibly do. So, like you mentioned, there's a couple of key areas of partnership that you guys tend to work in, and we're going to focus in on this concept of premium financing today. So Greg, why don't you give me kind of your big picture overview? What is premium financing?
Yeah, so premium financing, to boil it down, it's a way for people that have a need for insurance, typically your estate planning, sometimes your wealthy business owner clients, that know they've got an amount of coverage that they or their advisors have helped them understand they need. And they really have multiple ways they can buy it. One is they can purchase that using premium dollars to the insurance company, or they can look to borrow those dollars, borrow money for the purchase of that life insurance. And this has actually been going on for a good 15 years. A lot of, high net worth and ultra high net worth folks have been looking at financing. And I think what's interesting for those who are watching this right now is whether you're a client or whether you're an advisor that works with Altera, chances are you probably have heard of this before. I don't think that premium financing is a secret. And for us, it's not a magic solution. It's a way for clients that need the insurance to acquire it.
Yeah.
It's for many of our clients a better way to do it. It's a more flexible way to do it. It's a more dynamic way to do it. And oftentimes, if designed and then serviced appropriately, it should provide better economics.
And you guys will talk about this here in a bit, but it's not the, like you said, it's not the magic bullet for every single situation. But for a lot of situations, it's where it's not considered, it should be considered. In the
Yeah.
same way that people don't go out who want to be a real estate investor and think, oh man, I need to pay for every dollar of this property with my own cash.
Right.
Immediately, when people start thinking about purchasing real estate, they think, well, I got to start interviewing for
Right.
financing.
Yep.
And then there's some select areas where they may not actually choose that course. But like you said, it is a way to magnify results for the right situation. And regardless of if it's selected, for so many situations, should be at least on the docket of ideas that, if nothing else, are considered and crossed out.
Yep. And if I could mention one more thing.
Please, yeah.
So when you think about when you're acquiring that property, you bring up a great point. You typically are going to come up with 20-30% cash, and then you're going to borrow the rest. And the
Hmm.
reason clients do that is you're going to get better returns than if you paid cash for that $1 million property. And so the bank is going to give you, say, 70% LTV loan to value. When you look at leveraging a secure asset like life insurance, the bank is typically going to give us, and Joe, correct me if I'm wrong here, 95 to 100% loan to value. If it's 95%, that means the client has to come up with a small percentage on the collateral side. But the banks really enjoy and really like this business because they know that the asset that's being acquired literally can't go down in value. If you're talking about a type of product called whole life that has a steady dividend each and every year, the bank knows that dividend is going to be paid, and therefore the assets are going to be undergirded by cash value that can never go down in value. And we also look at products called Index Universal Life that have a similar floor of protection. So in essence, the banks really like when clients of this net worth and higher on the screen are looking to acquire life insurance via financing. It's a
That's
very
right.
secure asset.
Banks see the contractual strength of the underlying policies, and they also see through to the underlying counterparty, which is the insurance company. The insurance companies are some of the most highly financially rated companies out there, and many of them have high double A's, if not triple A ratings. So that is why and how the banks are able to assign such a high advance rate on their loans. It's the strength and the guarantees on the cash value.
So for those comfortable with this idea of leverage, you might even be able to apply that even further through this concept because the underlying asset is so secure. So great overview. So give me the high flyover of who should consider this concept.
Joe, you want to take that or you want me to?
Absolutely. So high net worth, ultra high net worth individuals, families. This could be through different family entities, trusts, family LLCs. That is what we see most often. Businesses can also borrow to fund policies for key person, for cross purchase on multiple business owners, or even for some unconventional, non-qualified deferred compensation structures. There's a whole market, a very interesting, unique market for that type of objective. Generally, we want to see net worths above 10 million, and maybe 20 million is really a proper starting point there. The banks want to see 10 million. I think we tend to see a little higher than that. Borrowing at least a million a year. So that initial loan size should be $1 million. So these are these are significant material life insurance policies that we're acquiring. Clients should have a long-term horizon. This is covering a risk immediately, but the policy itself takes a it should be a long-term objective, a long-term time horizon. It requires some runway. So that's a part of the right fit as well. And there should be a knowledge, tolerance, understanding of the elements of leverage and what it does to an asset return, both positive and negative. And we have found that there are good years, there are not as good years. And over the long term, we anticipate a spread to exist between policy returns and underlying borrowing rates. But on a year-to-year basis, that may or may not exist. So it requires a long-term time horizon and comfort maintaining leverage through good and not as good times.
Yeah, and I would just say too, Joe, one of the reasons we love working with you guys, and we're similar in this way. So much of what we do, and I know you guys do, today's evidence of that is education. I think the way that you design any strategy, if it's done appropriately, if it's done transparently, if you're using the right kinds of products and you're explaining to the client all the different, levers, if you will, that go into these strategies and what can go wrong and what should go right if properly designed. I think that's a really important part of this. And I think that, again, partnering with you guys, we're confident that every case that we help you with, there's going to be a heavy focus on education.
Yeah. Yeah. And it's such a good point because what's important is that somebody doesn't feel like I'm going to come with a problem and these people are already going to have decided what the right solution is. This
Right.
is a consultative process that includes this as one of a handful of solutions that could be the best fit. So that actually takes us to Greg, why don't you tell me in brief terms, who is this not a fit for?
Well, it's not for someone that doesn't have a recognized need for insurance. It's not for someone that doesn't want to put any equity or skin in the game into these strategies. It's not for someone that has either heard or they've been pitched, this is free insurance.
Mm-hmm.
This is insurance that is needed, that the client has the wherewithal financially to write a check to the insurance company. But as we'll see in a moment, based on the economics, some of those clients may decide to look at financing for a more dynamic solution. So it's not for the person that is being told this is a free lunch.
Mm-hmm.
You
Got
got to
it.
have a need for insurance. It's got to be a demonstrated need. Estate tax planning is a great way for us, I think, to utilize this capability and strategy because that's a long-term horizon where typically the estates are going to continue to grow over time. The tax is a real tax. It's a liquidity need that's probably not going to go away in our lifetime. And so it's not for someone that doesn't have a demonstrated need for insurance and who thinks this is a free lunch.
So I hear a couple of things. You have a legit need for the insurance, and now we're talking about ways to acquire it.
Right.
Two is you actually have the financial fit as well. Your net worth and time horizon is also a fit, and then you've got that tolerance for. I understand the pros and cons of leverage, and I'm comfortable with the risk to get the results.
Yep.
Yeah, awesome. Okay, so we're going to illustrate an impact like this through a case study. So we're using based on a case, Joe and Greg, that you guys worked on. Single father of three, thriving business owner. Started. I mean, it's kind of the classic story. Started in the garage, head down. r really just working day in, day out to bring this thing to life. And then you look behind you, and suddenly you have this growing empire, this growing business that you're excited about. But the goal for a lot of our clients isn't I want to amass this, this wealth necessarily. It's I'm compelled by an idea, and then it got big. So a lot of people who started out kind of bootstrapping, this idea, they are surprised at how their wealth has grown and then some of the issues that come from that. This is a really common version of this that we hear. I have, you just told me on paper I'm worth all this money, but what are you talking about? I don't have bank accounts that have $100 million in it. Well, this is a really common setup. My business has grown immensely. I've had to purchase and acquire real estate over the years in order to provide the facilities for that business. And I have captured some of my cash in investments, other assets, cash, investments, retirement accounts, and so on. But the vast majority of what I have is in the business. So at some point in an advisor, maybe it's somebody here at Altera, maybe it's an estate attorney, a CPA said, hey, by the way, I don't know when the last time is that you looked at your net worth, but you are keyed up for a pretty sizable estate tax bill. In this case, it was something on the order of $20 million was what he needed to offset. And I mean, you guys probably have endless stories about this, but when somebody learns for the first time, they might be teed up for a $20 million estate tax bill. Their like jaw hits the floor, their eyes get huge, and they realize there's a whole world of challenges they didn't even anticipate. So in this case, after becoming aware of this challenge, Adam was already pretty educated on the topic of life insurance and was convinced that was part of the solution. From your guys' perspective, though, what are briefly, so we can kind of focus in on this case study, what are some of the other ways you see people address a problem like this? Having to have an estate tax bill be paid, and they can't afford to have the business at risk of being sold in order to pay that. What are the ways people do this, and why do you guys generally see life insurance fits in?
Yes.
Well, I mean,
So
the first thing that, oh, go ahead, Joe.
Greg, I'll start,
Yeah,
and then I'll let you jump in as well.
yeah.
So the risk is that there isn't enough liquidity within the estate to pay the estate tax bill to the IRS. It's cutting a check for 20 million. There might not be enough cash and marketable securities to sell and write that check. So the risk right there is just an illiquidity risk. So what we're looking at and what we're finding out is the expected liquidity profile over time. Will there be sufficient liquidity in 5, 10, 15, 20 years to pay that bill? If not, that leans the conversation more toward insurance. There's also both gifting and wealth transfer strategies that can be implemented to move value out of one's estate into trusts or entities for their children's benefits that can reduce that estate tax and illiquidity risk as well. So when approaching a problem like this, we're trying to identify all possible solutions before we get to insurance. Advanced planning techniques is a major talking point and topic on the front end. So we've exhausted that. We might have implemented some strategies, and now here's the expected risk left over with the anticipated growth of the estate, future estate tax assumptions, and now this is the illiquidity risk. And the solution here is to prevent a sale of some of the family business, having to relinquish control of the family business that the client has spent the last 25, 30 years building on their own. So objective, maintain control, family business, not have to sell shares, maybe even at a discount if there's an urgency, which would be the check to the IRS. And so this solution is intending to provide and get to that primary objective of maintaining control of the family business.
Yeah, and I mean, simply put, also, so the problem is if I die and I want my business to go to my kids, a massive estate tax bill gets triggered by that. Well, life insurance just happens to be a tool that the event that creates the problem also creates the solution. And so in this case, Adam had kind of made his way through these steps and been told by an estate attorney at this point, hey, go look at the options, but you're probably going to end up with a big life insurance policy, potentially in a trust, advising on how to structure that. So you need to go talk to somebody about how to acquire this, which is where you guys come in. But it is important that somebody knows that when I come to the table with the problem, I will evaluate the different ways to go about doing this. One of which is acquiring insurance, and then one of those ways that I could do that, as we're going to get to now, is deciding whether I just pay it all out of pocket or whether I finance it. So, Joe, give us in kind of the high flyover here.
Mhm.
Adam knows that he's got an estate tax problem. He doesn't want to sell the business. He doesn't want his kids to be forced to sell the business. He's pretty sure life insurance is part of the solution, but he's not sure how to acquire it. So that's where you guys come in. So give me the big picture overview of the two key ways he could do this.
Great. Wide range of options out there. Two options are present here. One is a very traditional way to fund insurance, funding it over the first 20 years and securing 20 million of death benefit for your lifetime. The present value of all of those outlays is about 5 million, 4.8 million. And generally, traditionally funded insurance, so this is no leverage, no financing, just pay out of pocket each year, will generate a 4 to 5% tax-free return at life expectancy. If you die before then, it's higher. If you die after, it's later. It's the nature of insurance. Important to note there that insurance is a tax-free structure. So these are after-tax returns. Option two is a finance design. Bank funds the premiums up front. Client is just paying the interest on that loan. They're servicing the interest on the loan. They are having to put up some collateral up front for the loan, but their out of pocket is just that interest costs. And as modeled, the total interest costs, the present value of the interest costs for the first 10 years is about 3.3 million. So we're getting a discount to the traditional out-of-pocket funding. By having less out-of-pocket interest versus premiums paid, we're enhancing our after-tax return. So instead of a 4 to 5% tax-free return at life expectancy, we're crossing up in the 7 to 8% after-tax return range. So it enhances and becomes a more attractive tool, and that's what financing is. That's what it provides.
And Josh, if I could just say one quick thing, this kind of speaks to how we design, how we show the alternatives, but every client's different. You could have a client that is right now, their investments are earning 6% a year. Maybe they're just uber, conservative in their approach. And so if someone's getting 4.4 tax free, that's about a 7% plus pre-tax rate of return. For them, that could be perfectly suitable.
Sure.
And that client whose cost of capital is 6%, 7%, I wouldn't even consider financing. Just go forward with paying the premiums and away you go. But many of our wealthier clients, be it, highly compensated executives, business owners, they're investing in real estate or private equity or hedge funds. They've amassed their wealth by taking more risk. And as a result, their cost of capital is typically higher.
Mm-hmm.
They're used to getting 10%, 12% of their money. And so when you try to, convince them or at least share with them one of the alternatives to pay the premium to the insurance company for what they would say is a not so exciting 4.4 tax-free IRR, that's where they say, what else do you have?
Yeah.
It's not going to move the needle for me to pay $4.8 million over 20 years into a strategy giving me 4.4% tax-free.
Yeah.
That's where I think
Exactly.
premium financing can offer a more dynamic and hopefully a better economic outcome solution.
And you've contrasted two people perfectly here. One person who might find the first option attractive goes, I don't want to hear the word debt. I've spent my life getting out of
I don't
debt.
like leverage.
I don't like leverage. And I'm comfortable with a conservative return. If I get statements from the bank, it stresses me out.
Yeah.
And then you contrasted the other person. If I could use somebody else's money, why in the world would I use my own?
Yep.
So these are two very different people.
That's
You
right.
might, if you're watching this, you might identify immediately with one of those two statements. You might also, be like, hey, I lean a little bit this way. I'm not, extreme one way or the other. But if one of the things that we find at the end of the day is a lot of our particularly business owner clients are going, okay, got it. Hey, finance nerds. uh, I've hired you to give me simple outcomes and help me make an important decision, but in a way that I can walk through simply, choose the best impact, and get the heck back to business.
Right.
So at the end of the day, oftentimes we are looking at So you have to know the level of detail that's behind the scenes here, and we will show you briefly that in just a minute. But what we're simply looking at here is business owner, here's your cost and here's your benefit. Here's your cost and here's your benefit. As long as we've talked about the appropriate risks and the pros and cons in each case, you Adam here can pretty quickly see, as somebody who's used leverage across the course of his life, a couple of things. The first is I'm picking up some cost efficiency when I finance. I'm picking up enhanced death benefit, meaning I'm getting more bang for my buck. And I'm getting some dynamism here, meaning a strategy that can be flexible. So I'm out of pocket about 30% less. I'm about 25% higher benefit at age 85. And then, Joe, like you mentioned, with some of the growth and strategy design here, which is why the team, your guys' team is such a necessary component of this, because this is not just oh, go buy some insurance. You have to have an expert team that designs all of these moving parts so that these simple numbers that we're showing you actually come to play out. This is not something that just happens. You need an expert team that can actually design and bring this to life. Um, Now, okay, so if you're the How the Watch Works person, you might look at this and go, okay, well, why else? Why would I need to know anything else?
Right.
You could be a, did I say what time is it person or How the Watch Works
How the
person?
watch works
Okay,
versus how it's made.
so we use an analogy. There's some people that are what time is it people? Just tell me the thing that does the best thing and show me why you know what you're talking about. And then there's How the Watch Works people. This is a what time is it illustration. Here's a How the Watch Works presentation. So you guys are How the Watch Works people. You are looking at projected interest rates. You're looking at projected loan balances. You guys are interviewing different banks and pairing banks and insurance companies to a specific client's need. If you're watching this and you love the rows and columns, believe us, you can join the Finance Nerd Sandbox and play in
We
this
can geek
world.
out for hours.
We can geek out for hours.
Scenario analyses, different modeling of different rates, assumptions, you name it.
That's right.
Yes. If you see this and you go, it starts sounding like the teacher from Peanuts, want, 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 want. Uh, it's important still that you know that you have a team on your roster who is looking at this level of detail, which includes insurance companies and banks and financing rates and adjustments that we might make over time. Uh, just so that you can come back and confidently choose one or the other of these designs for your own situation. So, you guys, this has been a fascinating discussion. Really grateful for your guys' expertise and willingness to share your time to bring solutions like this
It's our
from an
pleasure.
educational standpoint. Um, Maybe share as we close here. We've talked a lot about numbers and estate taxes and problems and solutions and all this. You guys are finance experts. You could do lots and lots and lots of things with your talent. Why this? Why is this
You know,
something that you guys care about?
yeah, first of all, I think, we like to approach each and every client and each and every case with their own unique outcomes and unique solutions. This is not a black box that you just put every client into. This is a customized strategy, just like paying for your premiums. If you're just buying insurance and you're using a variable contract or an IUL or a whole life, there's lots of different ways that we can create each and every one of our designs. We like financing because we want to be able to show client options from day one and let them make their own decision, let them make their own choice. We also like financing because, like any other strategy, we provide the ongoing service. Whether you're buying insurance and you're using assumptions at the point of implementation that have to be kind of reminded and serviced every year, or if you're doing a premium financing strategy, the ongoing service component of all of these outcomes or strategies is fundamental. You've got to have it, and we have that at Schechter. So we are confident in how we design premium financing. We're excited to talk about any of these strategies, including financing, because we know we can back it up with the service we provide.
Greg, it reminds me of so my son, my youngest is 11, and he is fascinated. He just started investing, so he's learned about
Oh,
investments
wow.
and he's
Just
gets
like
on
Warren
Google
Buffett.
Finance and checks his portfolio and is now telling his friends incessantly about his stocks and so on. In any case, we're having discussions about what dad does at work, and we were talking through. I said based on what I've described to you about what we do. What do you think you need to be good at? And he said, well, you got to be pretty good at math. And he goes right into the numbers and the investment strategy. I said, that's right. What else? And he sat there and thought for a minute and he said, well, you probably have to be good at talking with people. I said, you could not be more right because
Right.
you have to be able to understand all these complex strategies, but communicate them in a way that doesn't just overwhelm people. It empowers them to be able to make decisions. But the thing that reminded me of this story is you said, we love backing up our promises. Because when I described to him the fact that when we build somebody a plan, they may sell their business because we've told them they can and their family's going to be okay. They may continue to run their business and count on it passing net of estate taxes to the kids that they love or the grandkids that they love. And he goes, "Wow, that's pretty heavy. You'd better be right."
It's a big responsibility. That's right.
Exactly. So being the team that loves to take the responsibility, these are big decisions people are facing. And so it's why, us here at Altera, taking an independent, comprehensive look at somebody's situation and then partnering with experts like you guys who go into the weeds and really extract all the ways that somebody in this situation could tackle some of these challenges. We're super grateful for your partnership expertise. So if you're watching this, you find yourself in a circumstance like this, please reach out. You can click the How We Work link at the bottom of the article. You can learn more about us at Altera. We're happy to connect you with the team at Schechter and bring their expertise into the comprehensive planning that you'll undoubtedly need. So we'll leave it there for now. Greg, Joe, thank you so much for joining today.